Good morning, ladies and gentlemen. Thank you very much for attending this very timely spring client update. Given the turbulence in markets over the last 10 days or so, I'm sure everyone's very keen to hear at least our input onto our thoughts on what's been going on. And as well, in particular, a very, very warm welcome to our new clients who come to us from the acquisition of the former BMI business in the Crown dependencies. Very good to have you on board. I hope you find our words of wisdom interesting and thought-provoking. Both Tom and I have been around a fairly long time. Me, fair to say, a little bit longer than Tom. And we've seen plenty of market dislocations over our careers, of which, for me, this is the 8th significant crash, if you want to view it as that, even though more recently we've seen a little bit of normality return to things. But nonetheless, I'm calling this a crash as well. And I guess my first point would be to say this too will pass. But let's really get into that in our main part. Tom and I aim to answer questions from each other for about 25 minutes. And then we'll answer questions which have come through from our clients, both during and prior to the event. Thank you very much for those questions. So without further ado, Tom, let's set off. World, nothing if not interesting right now. What is your take on where we stand today?
Well, firstly, thank you also to everyone joining us. As you said, we appreciate client support during the easier times, such as we've seen in the last couple of years, and certainly through the more difficult times, such as we've seen for the last couple of months. And lots of questions have come in, and we're always ready, willing, and hopefully able to answer those questions for all of you. And there's obviously lots of things that we can go through today. I think we need to try and keep things simple. You referred to it being interesting times. Interesting is just one of the adjectives that you could use to describe the current global geopolitical, political, societal, market, financial, economic backdrops, all of which are very complicated. So let's keep this simple. What have we really seen through the last couple of months? Well, I think there's 4 points really to focus in on. The first situation is that the economy is clearly slowing around the world. We were expecting it to, but recent events have meant that the global economic situation is deteriorating from a position of strength over the last few years. I think that's the first simple point to focus in on. The second point to make mention of the fact that tariffs are unhelpful, for want of a better word, in today's current situation. You know, the globalization of the last few decades is in danger of being rowed back on. In fact, it is being rowed back on. Let's be honest about it. We are in a different framework economically from where we've been for the last few decades. And we don't really yet have any clear certainty as to what happens next and what the end result of the current tariff situation is. We have some strong views, but we haven't got any certainty. I think if you really want us to give us our, most central view, it is that there are ideological tendencies within the Trump administration that tariffs are a way to level what they believe to be an unfair economic playing field, and they will be pursuing this with great gusto. But at the same time, I think there's also clear evidence in the last couple of days in particular that this is all part of the art of the deal that Donald Trump has espoused many times during his various careers, and of course the title of his book of a few decades ago. So I think the tariff situation is complicated, but I think to keep it simple, that would be what we're expecting. I think the third point that we need to recognize is the volatility we're seeing in markets. I mean, you referred to it as a crash. I mean, let's be honest about it. Market volatility has been pronounced and there's been some quite big drops in asset prices. But as we sit here today, markets have been unhelpfully poor in some cases this year, but we haven't seen some of the obvious declines that we've seen in previous crashes on a sort of consistent basis. We can get into that and more in the questions around asset classes later. But I think the point to note is that we do live in a world which is incredibly financialized. And I think very different to when you first started investing, and perhaps when I first started investing 20 years ago, it used to be more of the case of the economies-led markets. I think there's been a complete change in that situation. It's now markets that lead the economies. So volatility and asset prices falls are unhelpful. So that's point number 3. I think the fourth point here is the most important one, though. Structurally, and on a geopolitical framework, which has become more complicated, what we're really seeing here is complications between the world's two leading superpowers, the US and China. Clear evidence in the last few days that what Donald Trump and the US government are trying to do is throw as much sand into the Chinese economic engine as possible to clog up the gears, to try and slow China's progress and reduce down the threat of China reaching the same sort of global hegemon status that the US has enjoyed since the end of the Second World War. That's really what is the complicated story behind this and the backdrop. And that's not disastrous for asset markets. It just makes things more volatile. But I think that's really the thing that we need to focus on. So the clear message from this year is the geopolitical framework has become more complicated. We are now living in Trump's world, as simple as that. Tariffs and Trump himself are a reflection of being a symptom of the situation that we're in, rather than necessarily the cause, but that has made things complicated. I think we need to think about how that translates into medium-term market projections. We said at the start of the year that we were expecting to make positive returns from fixed interest. That has been the case. And we also expected to make further headway, albeit volatile, and less than it's been in the last few years from equities as well. As we sit here today, despite the falls we've seen, that is still our view. However, we need to keep in mind that we need to be very open-minded about what might happen next.
Yes, you're right to point out that the markets have probably pulled back a little bit from the precipice recently. But what if we're wrong, I guess? What if things would turn out worse than we expected? What are the drivers of that, and how do we expect things to develop that way?
Yeah, look, I think things have improved a little bit, but there's still a lot of volatility, and the moves we're seeing both to the upside and the downside are unhelpful, and they unsettle people. I mean, seeing markets such as the Nasdaq rising 12% the other day is not a sign of health for financial markets. Let's be honest about it. But I think the day before that, these are pigs all over the place. I think we had reached a point of capitulation in certain asset prices around the world. And on balance, if you think about the performance of bonds and equities this year, the global equity market is down roughly 10% in local currency terms. So unhelpful. But let's not forget how we've progressed through the last couple of years in 2023 and 2024, which were very good years for financial markets and for client portfolios. But I think the real question here is, Richard, what have we wrong? And I think we need to get into that in greater detail. So from an economic perspective, things have deteriorated. I think it would be foolish and naive not to recognize that. But we're not yet currently forecasting a global recession. The US economy is coming from a position of strength, and whilst things are fraying, they always were going to fray. The US government has supported the US economy through the last few years through absurd levels of fiscal spending that were just unsustainable. The Trump government has rowed back on that. And at the same time, the firing of lots of government employees, as pursued by the Department of Government Efficiencies, is unhelpful for the economic backdrop. So the US economy was always going to slow. But at the same time, we're seeing signs of improvement from China. And the Chinese government is committed to stimulating the economy to offset the threat of tariffs. But also at the same time, Europe has been in a period of stagnation through the last few years and is actually showing some signs of improvement. So I think the case of what if we're wrong here does depend on the economic situation deteriorating further. Because if that was to happen, we'll come on to this later, then expectations for earnings from companies this year are too high. They need to come down, and that would have a depressing impact upon equities, which, let's be honest, has already been reflected already. The equity markets on a global scale are down 10% this year because the expectations for economic growth and corporate earnings have already been revised lower because markets are a forward discounting mechanism. So I think the what if we're wrong point is really around the economic situation being worse and therefore markets being worse. I think there's one other point which has really come up in the last week or so that we need to tackle head on. People, because of the muscle memory of 2008, 2020 and 2022, take any period of volatility and try and overlay it with previous examples of market volatilities and elements of crashes. And, these things always do rhyme. They don't replicate each other, but they do rhyme. The big question here is whether or not the volatility that we're seeing in markets, particularly the bond markets, equities are always volatile. We expect that. The volatility in bond markets, though, is something different. What happens if something breaks? And that will be the question most censored in all of our clients' minds at this point in time. At the moment, we don't see that. The volatility is unhelpful, but we believe in particular the global banking system is sound. In the case of Europe and the UK, banks have been taking too little risk for the last 15 years, not too much. And we don't see a situation yet where the banking system comes under great pressure. If it does, that is a problem. Because if banks stop supplying credit to the economy like they did in 2008, and credit is the economic oil which fuels the economic engine of growth, then that would be a problem. But we don't see that at this point in time. That is an absolutely vital point to make clear. Linked to that, corporate balance sheets are in decent shape. They look healthy. They have not got any signs of excess at this point in time. Has the risk of default risen? Undoubtedly, yes. But has it risen markedly? I would suspect not in recent times. And finally, on the consumer side, actually, consumer balance sheets are very different to where they were in 2008. So we don't see that as being a problem. So I think that's the other thing. What if we're wrong? Is the economic situation going to be worse than we're currently forecasting? And secondly, could something break? As we see it, not yet, but we are absolutely open-minded and guarding against such a threat.
Yeah, thanks. So let's burrow into that a little bit more, because obviously it's only 9 days since Liberation Day was pronounced in the Rose Garden at the White House by Donald Trump and his buddies. Do we see any economic data that is being reflective of that kind of more negative scenario you just mentioned?
Yeah, I'm sure those 9 days feel like 9 years to lots of us, and I feel like, well, certainly me, not you, Richard, is aged 9 years in the last 9 days. But let's get into that, because that is linked to my previous answer about what if we're wrong. Absolutely key. What we're seeing right now is economic data, which is pleasing but irrelevant, because everything that happened before the 2nd of April is now old news very, very quickly. But what you saw in the first quarter was a continuation of hard economic data. So things like retail sales, industrial production, things like that were actually employment data, all perfectly solid and perfectly sound. In fact, in some cases, really quite healthy. But the world has changed in the last 9 days or so. And as I said, market volatility leads the economy. Also, we live in a world where economic activity is driven by consumer and corporate confidence. And that's obviously taken a hit in the last 9 days or so. But it was already starting to deteriorate. Consumer and corporate confidence has weakened considerably in the last few months. I think the question, without getting too technical here, is whether or not we start to see that hard economic data reflect some of the soft confidence data and start to deteriorate. And I think we will. But I think that's being factored in to markets as we sit here today. The big question, as we said earlier, is whether or not we see a global recession. And this one, we might. But at this point in time, that's still hard to predict and not our base case. If we do see a global recession, as we get into in our questions and answers later, we think that we're well prepared for that. Our portfolios reflect the fact that the world has become a riskier place.
Right, let's move on a little bit to some more macro things and some of those risks that come from what's happened. I want to talk about inflation and what interest rates might do in this new world that we're seeing.
Well, of course, central bankers, despite the fact that they are considered to be the masters of the financial universe, are grappling with the same problems that you and I are, Richard, and every other investor, that no one really knows exactly what's going to happen next. But like the central bankers, we have to weigh up what the balance is between inflation risks and economic risks. And so the central bankers of the world are currently trying to work out what impact the inflationary backdrop might see from rising tariffs and slowing economic activity. I think the central banks will look through, and you'll remember this word from 2020, and it proved very misplaced, the transitory impact on inflation from rising tariffs. I think central bankers will look through that and they'll recognize that economic risks have risen and they'll move to cut interest rates later this year. So I don't think it's unreasonable to expect the Federal Reserve in the US, the world's most important central bank, to cut interest rates in June and maybe another couple of times later on this year. Markets are expecting that. That's not unreasonable. And I think assuming we don't see a real significant lasting bump to inflation, that will be the path of interest rates in the UK and the US. But again, we need to keep open-minded on this. And I still wouldn't be taking, as we might get into in the fixed interest comments, a huge amount of interest rate sensitivity in longer maturity government bonds, because just like the central bankers, we don't know at this juncture.
Yeah, so let's get on to that. We've been positive on fixed interest since the late summer of 2022, and it's stood our clients in very, very good stead. Much water under the bridge since then. Are we still in positive mode on fixed interest?
Well, let's go some positive messages. I remain more positive, actually, or I've become more positive on fixed interest. And why? Because in very simple terms, yields have gone up. And yields going up improve the returns to clients. Yes, it provides volatility and some mark-to-market price volatility, as we've seen in the last few weeks. But ultimately, a fixed interest investor has to ask themselves what yield they're getting for lending money or income they're getting and through the form of yield to a company or a government for what period of time, and what are the risks of default during that period of time. And, the balance of probabilities is improved in the form of yields going up structurally in the last few years. I was much more worried about fixed interest risk in 2022 than I am now. And I don't want to sound, overly complacent, but I think we're confident that we'll carry on making money from fixed interest. So government bonds allocations have increased in our portfolios, and we've also taken on longer dated inflation insurance in portfolios that's also worked well in recent times. Both of those, I think, will be better performers looking forwards than they have been looking backwards. Corporate bonds, though, are an interesting situation now, because we got to the point, if we're honest, in February of this year, where there was a great deal of complacency. So in corporate bond world, you talk about the spread. The spread is the additional income return you get from investing in a corporate bond over investing in a government. It sounds technical, but it's fundamentally quite simple. Those spreads, that additional compensation, had narrowed to levels that, let's be honest, we were uncomfortable with. And we'd moved up in quality throughout our fixed interest allocations to reflect the fact that we weren't being compensated as well as we thought we should be. And as a guide, that additional yield was roughly in the form of higher risk corporate bonds, 250 to 300 basis points over what you get for investing in a standard government bond. As of today, that is 450 basis points extra yield per annum. That's gapped up to reflect the changing nature of risks in the global economy, which provides additional compensation for clients. Now, we're not, as we did in the summer of 2022, yet taking advantage of that, because we think there'll be more volatility. But those are the sorts of ways that we can use the volatility to our advantage and add to future prospective returns through slightly chaotic markets for clients. We need to take those opportunities. And the good news is that those opportunities are being presented to us.
Thanks, Tom.
So it's time to turn the tables. I've got quite enough of me. I'm going to ask you a question, which I'm going to try not to end up in trouble with the HR department. I'm going to use the term experienced, but you are definitely experienced in the form of investments. I hope you don't mind the terminology, but how does this compare to the last 40 years of investing and some of the things that you've seen previously? What lessons might you be able to learn from those previous areas of volatility that might stand our clients in good stead this morning?
Yeah, I think you've already said that each of these crashes or periods of turbulence, whatever we want to call them, have been different, but they do rhyme. And for me, this is a little bit more like 1987. I'm afraid I have been around since then, than some of the other ones, partly because the underlying economy in both occasions was pretty robust, partly because the change when it occurred came as a complete shock, partly because, as quite often happens with crashes, they uncover areas of leverage which people weren't particularly aware about. And finally, that was also in part the reaction in 87. It was in part the reaction to a previous attempt to do something about the US trade deficit. So that's, in broad terms, the nearest equivalent if I had to choose one. But everything is a bit different. This one actually, so far, now, after that big bounce you mentioned, hasn't been that much of a crash at all, more of a correction than a bear market at the moment. But we shall see what happens.
So in terms of equity views, and you and I came on one of these webinars, which feels like an eternity ago, but only 3 months ago, to talk about our outlook for the year ahead. And we said at the time that we expected to make positive returns from fixed interest and equities. We've covered the former of those asset classes, but has anything really adjusted in our own thoughts about the outlook for equities and perhaps the relative merits of them within a client portfolio?
Those people who've had the dubious pleasure of listening to me on these things before will know that I do bang on about investing in quality equities. By quality equities, we mean highly profitable companies with sustainable competitive advantage who can therefore continue to be highly profitable, not too stretched balance sheets, and importantly, reasonable valuations. And the great thing about movements that we've seen in markets, like we see in the last couple of weeks, is that we've now got more opportunities in that space, so long as our core prognosis of the market not moving into recession holds true. So actually, our opportunity set has widened as a result, as companies have pulled back in valuation, and some things which we like very much as companies and have felt have been rather too expensive are now beginning to perhaps become more interesting. And at the same time, because there is so much turbulence, and we might talk about how indiscriminate the market has been at times in the last few days, that's also producing opportunities outside of that core part of our portfolios in the more satellite areas, whether that be in some of the financials, which have pulled back quite hard, or in some of the more defensive areas, which have been hit in the indiscriminate areas. So, in the indiscriminate self. So, for us, this is at the moment is more of an opportunity occasion rather than a worry per se.
You mentioned a couple of things there very interesting, in particular that indiscriminate nature of market moves. And we do see this through periods of volatility because, and I'm sure lots of our clients do, they look at the performance of financial markets and assume there's an economic story, understandable, fundamental argument behind why markets or individual assets are performing the way they do. But a lot of this goes down to market mechanics, as we've learned through previous market shocks. Someone's taken on too much risk, or there's too much leverage here, or something's being unwound here. And that does create moves that don't necessarily make sense. And I think we've started to see some areas like that in the last couple of weeks, haven't we? Some indiscriminate moves. So what might that mean for our portfolios? And what could it mean to future market returns?
So, first off, let's just remember that at the beginning of the year, the focus was all on the Mag 7, those technology companies which had done so well in 2023 and 2024, and had been by far and away the biggest driver of market returns. Initially, actually, this pullback we saw, have seen, and focused in the United States, as we said, was more driven by those companies, in particular because of the launch of a Chinese version of an AI large language model called DeepSeek, which made people worry that perhaps the Western model of AI was too expensive. So I'm talking about names like Nvidia and Apple and Tesla and those kind of things. And quite a lot of those are now down 20 to 30%. So Apple down 22%, Nvidia down 22%, Tesla down 33%, Google and Amazon down about 20%. So some big movements in these companies. Now, they were very expensive, very good quality, but very expensive. And now I would warrant to say that they're a little bit less expensive, but not outright cheap, but they are still very good companies. But then after that, and they did start off the trade-related downdraft badly because a lot of them make stuff in China. But after that, of course, other companies which make stuff also in the tariff world or in the tariffed world suddenly got hit too. So a stock like Nike, which makes its trainers and running shoes in Vietnam, Vietnam was hit with 46% tariffs, and Nike collapsed on that news because people felt that their profits would suffer as a result. And then, as I said, you get this uncovering of leverage, hedge funds, individuals with too much leverage. As the market goes down, they're asked to make margin calls, and sometimes they can't afford those margin calls, so have to sell stock indiscriminately to meet their margin calls. So even food retailers, which had held up pretty well, started to come down in that phase. So this is what I mean about the broadening out of opportunities. And in areas like healthcare or infrastructure, where initially we saw some good defensiveness, and which have more recently just come a little bit more wobbly, those are the kind of things where this is an opportunity for us to add to our positions rather than to reconsider. And as you say, the whole ethos of the core part of our investment philosophy in equities is by its nature quite defensive. Those cash generative, low geared companies will tend to do well relative to other equities in periods of market uncertainty. So it's not a bad place, really.
So please bear with me a second. If you go back to our early introductions to working wealth management, and I'd like to think we both would have carried on with those careers when we first started them if we'd known what was going to happen the next 40 and 20 years respectively. But we were told that equity investment, stocks and shares, went up or down based upon a company's fundamentals. I did say bear with me. So one of the key optimistic views ahead of this year, and in fairness, a fundamental pillar behind why we expected to make a positive return from equity markets this year. And whilst overall equity markets are down, there are still some parts of the world which are up this year in pound terms, and there are still some countries which have done quite well. So put that to one side for a second. We'll come back to that in the questions afterwards. But if earnings of companies drive share prices higher or lower, what would that mean for our expectations of this year? Because at the start of the year, I think the S&P 500 companies, that's the world's biggest equity index, which is in the US, was a forecast of 14% earnings growth for 2025 calendar year. Now, my suspicion is that that's somewhat antiquated now. But what are your expectations for corporate earnings, and what might that mean to the stock market direction going forwards?
Yes, I mean, you mentioned that 14% number. And for those of you who read the financial press, you're probably aware that you have equity analysts and you have investment strategists in investment banks. Equity analysts are much slower to react. So when we looked yesterday at equity earnings estimates from equity analysts, they'd scarcely moved at all, despite all the volatility we've seen in the last 10 days or so. Strategists have moved their forecasts down. So typically, and it's a movable feast, as I'll come on to in a second, typically they're ahead of equity analysts, and most of them have reduced earnings estimates by between 5 and 7%. So not quite halving in total, but down to 7 to 10%, that kind of area for 2024. The other thing to bear in mind is we're just entering, I mean, Trump did pick his moment, we're just entering the first quarter earnings season in the US, where we're going to get a lot more information from companies about how they view their exact exposures to this shifting world of tariffs. And we'll get a better idea, which will allow the equity analysts to catch up and probably downgrade earnings expectations. And the final thing that I'd like to say around this is that one thing all of this definitely has done, it's increased the risks, as we've already said. In equities, that's reflected in something called the equity risk premium, which is basically the level of risk that is priced into equities. And that's clearly going up. As that goes up, as the equity risk premium goes up, the valuation on equities inevitably comes down. So we're going to have less earnings, almost undoubtedly, as a result of what's gone on. And the valuation on those earnings will also be lower. Does that entirely wipe out what we still have as a positive year for equities? No, not yet. And we've talked about some bad scenarios where perhaps things will need to be reassessed later on. Flexibility is a key attribute right now. But as we stand today, we still see equities making a positive return, in part from earnings, in part from the fact that outside of the Mag 7, the rest of the market entered this in not such a high valuation place. So actually, from a blended point of view, there's plenty of reasonably valued assets. Now, in 2024, we started the year saying that we felt both equities and bonds would add value to client portfolios, and they did. In that instance, equities produced a little bit more work, did a bit more work than bonds. This year, I suspect bonds will provide the lead to equities, and equities will play second fiddle. It's not a bad thing. I still think we'll end up at the end of December in a positive place. But equities, perhaps, as I say, playing second fiddle to the primary role of first violin with bonds today.
Well, I think that's quite enough of us. I'll sum up quickly, and then I'm going to hand over to your cherished role as question master. Need the experience to ask the questions. Perhaps I won't have the answer to it. We'll wait and see. But let's sum up quickly.
Fair. I'll try and be fair and share them out a little bit. But we have some for which we thank our clients as always. And I'm going to start by throwing one in your direction, Tom. We haven't really talked about currencies yet. The question is basically, Donald Trump seems to want to have a weak dollar, but also for the dollar to remain the world's reserve currency. What's our take on this? And as a side question, do we have a view on sterling at these levels?
Let's park the view on sterling for a second and focus in on the big picture and what really matters around the world at the moment. So Trump's plan is extraordinarily complex and revolutionary in many ways. What they're trying to do is reduce down what he views to be economic imbalances between the US and the rest of the world, which started before the addition of China to the World Trade Organization in the early part of this century, but have accelerated rapidly since then. He's trying to bring back manufacturing strength and success back to the US. He's trying to improve the economic standards of places like the Rust Belt without being derogatory in the US. And he's trying to enrich the US economy, which he believes has been, I won't use the terms that he used, but has been subjected to unfair practices by the rest of the world. I think in order to do that, a weaker dollar would help. And I think that is part of the plan. At the same time, keeping the dollar as the world's reserve currency whilst aiming for a period of currency weakness are not necessarily linked, but they're not necessarily a million miles apart as well. I think the US will continue to be the world's reserve currency. It will have some challenges. I think other parts of the world will see their share of global trade grow. And we have been seeing this already for the last 20 years anyway. I mean, if you look at the euros remain really constant, but we have seen increasing trade in things like the yuan and various things like that. I think we'll continue to see that. But in simple terms, does the US get replaced as the world's reserve currency very quickly? No, it doesn't. Will we expect to see a period of US dollar weakness as we move forward as part of Trump's plan? I think we will. So in order to try and link that into what we might see about the pound sterling and taking a more parochial view, aside from a period around the Liz Truss incident, when the pound got down towards parity against the dollar, and aside from a slightly unexplainable period last year, where the pound went up towards 140 against the dollar, there's really been a sort of post-Brexit trading range of roughly 119 to 133, where the dollar and the pound have oscillated quite wildly in a narrow trading range. I don't expect that to change massively going forwards. I mean, anyone who's made any currency projections throughout the time I've been observing markets has normally got them entirely wrong. And this might be another case of that now. But I think the UK and the US share a lot of the same deficiencies around government debt, around the lower economic projections that we're going to see. So whilst the UK pound would continue to be weak on a global basis, I think the dollar weakness that Trump is aiming for will help to offset any pound weakness that might emerge. We need to remember that the UK economy is not in a good place. The UK economy is bordering on stagnation. Yes, I recognise that you'll see in tomorrow's papers that the February GDP numbers were much higher than any economist projected, but that's 1 month. I mean, let's be honest about it. The medium-term outlook for the UK economy is not particularly good. At the same time, the borrowing costs that the UK government is having to pay to refinance and issue new debt are substantially higher than any other of the nations in the G7, with the US being the only one which even comes close to it. That, again, is a concern. And of course, in order to fund some of the Labour government's more grandiose plans, they are in danger of falling into a tax trap, as we mentioned on previous calls, where they have to keep on raising taxes on the only people who can pay them. And that causes lots of people to flee and leave the UK economy. So I think the UK's economic weakness will be offset in the currency markets against Trump's plan to weaken the dollar. But I don't think the outlook for either of them is particularly impressive.
Thanks. So, and actually, that leads on to the next question, which is actually for me, really. One of our clients has kindly pointed out that the UK has actually outperformed the US this year for the first time for a while, so certainly since a period in 2022. And we've been talking about the valuation opportunity in UK equities for some time. So the question is this the beginning of a move away from US equities, which, as we said, have been very much the primary source of equity returns over the last few years? In some ways, I hope so, but we've got to look at the UK in through two prisms. It would be my answer. The first is there's the FTSE 100, which, as most people know, is not really a UK index. It's a bunch of companies which happen to be listed in the UK, but 75 odd percent of the earnings from those companies comes from outside of the UK, and indeed about half of them come from the United States itself. So the FTSE 100 has outperformed the S&P 500 this year, but it's not really the UK. Smaller companies in the UK have actually performed worse yet again, despite the relative valuations, than their large company peers in the UK. So I don't think we're there. I would even say we haven't started to outperform properly in that sense. So I do think there's still a valuation opportunity in smaller companies in the UK. Nonetheless, I don't want us to think that the really great companies that are listed in the US, some of which are under a little bit of pressure now. I've mentioned a few names already today. I don't think we should start to ignore those either. It is still, despite re-onshoring, despite the schism that's occurring between the Chinese dominated part of Asia and the West dominated by the States, despite that, I don't think we should be re-onshoring all our assets to the UK. Quite the opposite. Well, our mantra, Tom, as you know, is balanced, diversified, and flexible. Never has it been more important to be diversified. And so don't get too excited by the UK just yet.
So that links into another question we've got quite repeatedly from clients so far this year, and is linked to views around portfolio strategy. So are we in a situation where the relative outperformance of markets like the FTSE 100, which I think are basically flat this year, against some areas of the US market, in particular big technology names, which are down, as you said earlier, 15, 20, some cases 30%. Is there a case to be made for relocating some of those assets we have in the UK towards some of those markets which performed less well this year, including those very big technology companies in the US?
I think there's absolutely a case for that. As you know, within our broader business, we've been doing some of that already to take advantage of the lower prices in that great market that is the United States. I think people should lean into this weakness to do that if they're not already internationally diversified adequately. So I think that is an opportunity. And again, I like to think of moments like this not as the sky falling, but more as where can we make money going forward. And I think this is a good opportunity to balance portfolios in that way. Yes. I've got one. I know this right up your street, Tom, as well, because I know we've talked about it independently before. The question's been asked, if Trump forces peace on Ukraine, does that change prospects for our client portfolios? And will he get the Nobel Peace Prize?
I just want to point out that you said you're going to be very fair with the question sharing, but you seem to have got some very softball questions. Yeah, I seem to be having some particularly difficult googlies. So I don't know really where to start with this one. Maybe we'll look backwards. At the start of the year, when you and I did the last webinar, we did say that we expected there to be peace in Ukraine. And that we believe that this would be something which helped to reduce risk premia. So, a risk premium in markets is, the additional return that you have to get for investing in risky assets. It will reduce the overall risk in markets, and therefore people will be more optimistic about the outlook for markets. That was our view at the start of the year. I think that's been rendered redundant, if I'm honest, because I think the geopolitical backdrop has become so complicated now that any peace in Ukraine, the bringing back of Russia into the global fold, even to a certain extent, I think is somewhat of a sideshow now in the much bigger picture that is the US-China relationship, which is deteriorated further this morning. We saw before we came into today's webinar that the Chinese have now ramped up the US tariffs even further. And this is all part of the big picture. I mean, in previous webinars, I've referred to one of my favorite books of the last decade, which is The Thucydidean Trap, written by Graham Allison. And it refers back to classical Greece, which I studied in university. And it talks about how difficult it has been through history, through one global leader to pass power over to another global leader. And that had always previously led to military conflagrations and war. There are only two exceptions through thousands of years of history where that hadn't been the case. And obviously we hope that's not the case militarily here, but it is going to be the case from an economic, financial and political perspective between the US and China. So really the Ukraine war has become somewhat of a sideshow. And I think even a positive resolution there is not going to be that helpful. So as to whether or not this leads to Trump getting the Nobel Peace Prize, I don't want to bet anything on that at this point in time. I would point out that Mr. Obama did get it for a bit less than generating base in the Ukraine. But let's perhaps leave that one to the left field suggestions for later on this year.
Thanks, Tom. And in fairness, we've got time for one more. And in fairness to you, and the fact that I have been catching the easy ones, the last question we'll cover off here. And please do contact your account executives and your portfolio managers to pursue some of these themes in more depth. But the question is about gold. Gold stands today at an all-time high in nominal terms. And even in inflation-adjusted terms, it is pretty much an all-time high. So do we have exposure? And what's our view on gold? Now, I've got to preface my response to this with, I am not a gold bug. Some people are, but I am not. But something interesting is happening with gold right now, because we have broken out of a long-term range. Tom did ancient history at university. I did archaeology, so both of us have a prism of centuries rather than decades. Over the last certainly 200 years, which is where we've got some reasonably accurate data, and you can go back to the 7th century BC if you want to, where it's a little bit less accurate data. Gold has broken out of its long-term range recently. By a large factor. So something different is happening now that didn't happen before. One of those things, almost certainly, is this breakdown of trust between China on the one hand and the US on the other. So China is a consistent purchaser of gold at the moment because it's got too many dollars in its central bank balance sheet. It's been a seller of US government bonds, is the rumor recently, into this volatility. China is looking to diversify, as other countries are as well. And the other thing that's happened, and it's very much more difficult to put a finger on it, is that gold has begun to act a little bit more as a separate asset class on its own, in tandem with similar things like cryptocurrencies, which are inherently very difficult to value. And is acting as a separate buffer at this particular time. So something interesting is happening. We do have exposure to gold through some of our alternatives exposures, where it's appropriate. We've got gold in client portfolios too. And we do have some of our alternative, as I say, managers with gold exposure. More recently, in our model portfolios, where we did have some gold mining equity, we've actually taken the opportunity to sell those after a very, very big bump in their share prices. So yes, I think there's a place for gold in portfolios, despite my innate not liking gold as a gold bug. But just be aware that it's at very, very high absolute and real prices compared to a very long history.
I'm only disappointed, as I'm sure all our clients are, that you didn't get to the story about the centurions being paid in gold and how that had kept pace through the last 2,500 years. But we'll save that for the next webinar. But I think more importantly, it is a classic point about how markets shift in terms of sentiment and the feeling towards different assets, which we are employed to take advantage of. So if you go back 14 months or so ago, the attitude towards gold, and particular gold mining equities, was almost nuclear. The sentiment towards the asset and gold mining shares material was miserable. The sentiment towards US equities was extremely hot and only got hotter till we got towards the end of 2024. As we sit here today, the attitude of investors towards US equities is miserable. Oh, how strange the change between optimism in November of last year and misery in April of this year. Those are the sorts of things we're taking advantage of. Likewise, the move from absolute total pessimism towards gold mining shares and areas of gold investments 14 months ago to now almost record enthusiasm for gold as an investment It's our job to try and read those market waves and try and take advantage of them for clients, as difficult as it seems here today. So just to sum up very quickly, in terms of what's changed so far this year, what are the key messages that you should be taking away? The first thing to note is that the economic situation has deteriorated, but we are not yet forecasting a global recession. Markets have moved to react and reflect the fact that the economic prognosis is less optimistic than it was only 3 months ago. The second thing to note is that tariffs are a part of this, both in terms of confidence and in terms of economic activity. We don't know yet what's going to happen entirely with the tariff situation. We suspect that we are in a new paradigm for tariffs, but there'll be some leveling of the playing field. And ultimately, this is part of the art of the deal that Donald Trump has talked about previously. Again, we have to recognize that we need to be open-minded about that. The third point is the market volatility. That does typically lead economic activity in terms of sentiment, but we believe that, just as Richard said earlier, this period of market volatility will pass and opportunities will be presented. I think the fourth point, and absolutely key to our interpretations of the world that we live in now, is that this is a great deal a reflection of the deteriorating relationship between the US and China. We have to recognize that's part of the turbulent 20s framework we've invested in and talked about since 2019. That creates both opportunity and risk, and it's there for us to take advantage of. And finally, the fifth point, and perhaps most important, a lot's happened so far this year. I mean, that's really a lot's happened in the last 9 days, let's be honest. But we have not changed our investment philosophy. We are making shifts to client portfolios, but nothing too radical. And we stand aware and open to taking advantage of opportunities presented in the market volatility. We remain balanced, diversified, and flexible in mindset, and ultimately trying to take opportunities that volatility might present. Thank you for your time. Have a great weekend.
Thank you very much.